Hello everyone. Let's continue our previous session on capital budgeting. I'm using this same spreadsheet and we'll take it forward from where we left yesterday. I hope you are able to see my screen. So in the last session, we computed net present value at a cost of capital of 8%. So we talked about compounding, discounting, and then we took a small example for net present value, which is nothing but excess of cash inflows, discounted cash inflows over discounted cash outflows. It could be a negative value, which means it's not a good project to select. Now, moving on to the next concept is your IRR, or internal rate of return. So we saw that at 8%, we have a positive net present value of 37,722. So we invested 1 lakh and we had various cash inflows over 7 years, and we discounted it at 8%. 0.08 is nothing but 8%. So we discounted it at 8%. In your problems, normally what they'll do is, instead of you doing this, they call it a PV factor. So first year is always 1, second year 1 plus 0.08 to the power 1 by 1 by and they normally give it to 3 or 4 digits. So let's keep it to 4 digits, the display. So first year, there is no discounting because it's happening today, year 0. So if you receive 1 rupee at the end of 1 year, the present value of that 1 rupee at 8% cost of capital or discounting at 8% is worth 92 paise or 0.9259 rupees. Similarly, if you receive 1 rupee at the end of 2 years at 8% discounting, today's value is only 0.8573. So this is what they normally give you as PV factor. So it's nothing but 1 divided by 1 plus r power n. Here 0.08 power year, number of year is n, or t, however you want to refer it. So now, instead of having such formula in that cell, I'm just going to multiply the actual cash flow by the PV factor. I'll just undo and show you what was the previous value. If you see here, the formula changed, but the value has not changed. Both are the same. So I changed all the formula just now. Okay. Now let's park this for a while, go back to IRR. Internal rate of return is the return or rate at which the NPV is 0. Okay, that sounds pretty simple. The workings may be a bit difficult. So I guess if you do IRR comes to 19%. If you are doing it in Excel, it's pretty simple. Let's check the calculations. 18.62. So PV factor at 18.62%. First year anyway 1. Second year onwards 1 divided by 1 plus R 18.62. Because it's shown as percentage, when I add it becomes 0.1862. I'll freeze the reference to the power number of years. So PV factor at 18.62%, so equal to this number times this. So we have the present value of the 7 years cash flows. So we'll do total as we did earlier. You see the present value of the future cash inflows is also 1 lakh. So this is what we calculated here. PV of inflows, net present value 0. Again, if you do it in Excel, it's pretty simple, straightforward. You can get to 18.62 quickly. However, if you have to manually calculate it, it's a bit tricky. So look at the NPV you get by using a percentage, some given percentage. It could be cost of capital. In this case, since they said 8% is the cost of capital, we calculated it at 8%. So let me take a different example to explain this better, because since I know the answer, I may tend to take a rate closer to 18.62 to prove or show you how to calculate IRR. So I'll take a different example. Year 0 onwards, say 8 years, 2 lakhs cash flow, ran between 20,000 and 50,000. I'm saving it as values. PV at say 10%. Let's begin with 10%, equal to 1 divided by 1 plus 0.1 to the power 0, 1, 2, 3, and so on. So this is your PV factor. Present value, your cash flow times your PV. Unfortunately, if I just add it all up instead of doing separately the inflows and outflows. We are 27,000 negative present value. So the project cannot be selected. However, I need to find the IRR, internal rate of return. So internal rate of return is the rate at which your present value of outflows equal present value of inflows. So here it is 27,000 negative. So what you are trying to calculate it, what is the rate at which I can borrow to invest in this project? So if I have to negotiate with my lender, my bank, at what rate if I borrow, at least I'll be breaking even. So 27,000 negative. So if you higher the rate, it's showing a negative present value, which means my cost of capital is high for this project. I need to reduce it a bit more. So let's do it at 7%. 7%, 1 divided by 1 plus 0.07 to the power so PV at, so now revised PV times wow, even at 7% it has a negative PV. Can you find out IRR using this? Yes, you can. So it's called, normally you refer it to as cross multiplication. Here they call it extrapolation, because extrapolation, that is a 10%. So at 10%, PV. So at 10% rate, our PV was 27,000, and then at 7% our PV was 7,000. So movement is difference or difference. So when we reduced our rate by 3%, our PV moved down by 19,000. So for a movement of 3% rate, the present value improved by 19,000, I should say. It was at 27,000 negative, now it is 19,782 negative. So if 3% produced, I would say differently, how much more do I need? So for a 3% drop, it was 19,000. So if I have to have a drop of, so let's move it down here. Or just a moment. So for a movement of 3%, we got a total movement of 19,782. But what is the total movement required? This must ideally become 0. This 7,764 must go away. Only then the IRR can be calculated, or the NPV can become 0. Make it 0. So to make it 0, I need to move 7,764 more. So 7764. How much more rate change do I need to make this movement? I need additional 7764 movement. So let's find out using cross multiplication. Cross multiplication into 3 divided by this. Hope I'm correct. So percentage. So for a 3% movement, I had 19,782. I need another 7,764 movement, which can be achieved by reducing the rate by another 1.18%. So the total movement required from 10% is 4.18, which means IRR should be somewhere close to 5.82%. So let's try it at 5.82%. Equal to 1 divided by 1 plus R. Our rate is 5.42 to the power number of years. Since anything to the power 0 is 1, we get 1. I'm just pasting it for the sake of format. So updated the formula. So PV at this rate times this. Okay, so the magic should happen. Unfortunately not. 5.82 gives us a positive PV. But for calculation purposes, it is okay. You can do this calculation. Your normal calculation is say extrapolation or interpolation. Now what we did here was extrapolation, which means we had two numbers 10 and 7, and both had negative present value. So with these, we want to find a rate which is outside these two numbers, not between 10 and 7, but something outside 10 and 7. So extrapolate and find out that rate. So because of approximation, we got 5.82. Now let's try it again. Since 5.82 gives us a positive value, 982, let's do interpolation now. Rate and present value. First is 7%. Next is 5.82%. It was not exactly 5.82. So let me make it 5.82. So it becomes 1002 now. So at 7% it was negative NPV of 7,764. At 5.82 it becomes a positive NPV of 1,000. Now the difference for a movement of 1.18%, our NPV moved by a total of 8,765 rupees. Remember or understand, it was a negative 7764 which came all the way down to 0, then became a positive 1002. So 8,765 is the total movement. Ignore the sign. So instead I can do plus. So 78765. All you're doing is just measuring the total movement. The movement in rate was 1.18 and the movement in present value was 8765. So let's start with one of these numbers. So normally how they calculate in your book, they start with either 7% or 5.82%. If it's 5.82%, the rate must go up. If it is 7%, the rate must come down, because at 7% we have a negative present value, negative NPV, and so let's call this NPV. At 7% we have a negative NPV, at 5.82 we have a positive NPV. So if you start at 7%, you have to reduce the rate. So it must be 7% minus the cross multiplication I was talking about. If I start from 7%, how much should I come down? 7764. So I need to come down by 7764. So before that, the total movement of 1.18% for how many rupee change? 8765 change. So for every percentage point, what is the rupee change? Or for every rupee change, what is the percentage change we are calculating? Now multiply that by, I have put it in the bracket because it's a separate working, and then multiply by, we need to bring down the NPV by 7764. So if you do this, you will get your IRR. So let's try it. 7% minus 7764 in the numerator, 1.18 in the numerator, cross multiplication. $7,764 into 1.18%. Normally, again in your book, the percentage will be applied towards the end, but I'll apply it here. The whole thing divided by movement of 8765, cross multiplication. That's it. So it says it should be 5.95%. Extrapolation. So 7%, when we start from 7%, the rate must come down, so subtract it. For a movement of 1.18, if it is 8765 rupees, so what we need is a movement of 7764. To achieve that, what should be the change? And if I apply that, then we get a final number of 5.95. First change this. And then for simplicity's sake, $5.95, right? So 0.0595 x. So now is just 6 rupees. Again, IRR, manually calculating IRR is just an approximation. You cannot expect the exact number in your exam. So if you come up to this 6 rupees, that's excellent. So your final number is 5.95%. Probably it's a bit more, 9548. We can even do that because it's Excel. 9548 it becomes minus 31. So let's keep it at 5.95. So 6 rupees is a fair number. So to get the exact IRR, let's now look at Excel's formula. IRR, just give the values. So it is 5.9508. Our calculation comes to 5.9548. It's a third decimal variation, so don't worry about it. So this is how you calculate internal rate of return. So internal rate of return, why do you want to know that? So if I can borrow from somebody at a rate lower than 5.95, I'll make a positive net present value, or at 5.95, I'll make no profit, no loss in terms of present value. So that's a good thing to have. And this could be your basis for talking to your bankers or lenders. Otherwise, if your cost of capital is 8% or 10%, you have to necessarily forego the project. You cannot take it. You will not be able to run it at a loss. So thank you all. I'll get back to you again sometime soon with more on capital budgeting. So these are the two key concepts. Once you understand how NPV and IRR works, the rest of the capital budgeting is pretty straightforward. So all the best. See you soon.